I call this hearing to order. Today, we consider the nomination of the Honorable Janet Yellen to be a chair of the Board of Governors of the Federal Reserve System for a term of 4 years. Dr. Yellen is an extraordinary candidate to lead the Federal Reserve. She currently serves as a member and vice chair of the Board of Governors. She previously served as a member of the Board of Governors in the 1990s. She was the chair of President Clinton's Council of Academic Advisors, and she served 6 years as the president of the San Francisco Fed. In addition, Dr. Yellen has an impressive academic record. She is a professor at Berkeley-Haas School of Business and was previously a professor at Harvard University, as well as a faculty member of the London School of Economics. Dr. Yellen graduated summa cum laude from Brown University and received her PhD in economics from Yale. Dr. Yellen's nomination is especially timely as our nation struggled with high unemployment in the wake of the Great Recession. She has devoted a large portion of her professional and academic career to studying the labor market, unemployment, monetary policy, and the economy. Dr. Yellen also has a strong track record in evaluating trends in the economy. Her academic analysis has been spot on. The New York Times recently noted that she was, quote, the first Fed official in 2005 to describe the rise in housing prices as a bubble that might damage the economy. She was also the first in 2008 to say that the economy had fallen into a recession, end quote. These forecasts were not an anomaly. The Wall Street Journal recently analyzed 700 predictions made between 2009 and 2012 in speeches and congressional testimony by 14 Federal Reserve policymakers and found Dr. Yellen was the most accurate. Such accurate economic judgment would be a tremendous quality of a Fed chair. Dr. Yellen has proved through her extensive and impressive record in public service and academia that she is most qualified to be the next chair of the Federal Reserve. We need her expertise at the helm of the Fed as the nation continues to recover from the Great Recession, completes Wall Street reform rulemakings, and continues to enhance the stability of our financial sector. I'm excited to cast a vote to confirm her as the first woman to serve as chair of the Federal Reserve, and when we vote on the nomination, I urge my colleagues to do the same. I now turn to Ranking Member Crapo for his opening statement.
Thank you, Mr. Chairman, for holding today's hearing on the nomination of Dr. Yellen to be the next chair of the Federal Reserve Board. Today's hearing is an opportunity not only to examine Governor Yellen's qualifications, but also her views on the role and direction of the Federal Reserve. In recent years, the Fed has engaged in unprecedented policies, including purchasing trillions of dollars in treasuries and mortgage-backed securities. Current Fed purchases total up to $85 billion a month. As a result, the next Fed chair will inherit a balance sheet that currently stands at approximately $3.8 trillion, 4 times higher than before the financial crisis. As I think everyone knows, I've been a longtime critic of the Fed's quantitative easing purchases. Now that a reduction in asset purchases finally seems to be on the horizon, I'm concerned that markets have become overly reliant on them. That's why it's essential to know how Dr. Yellen, if confirmed, would manage the process of normalizing our monetary policy. The Fed has indicated that it will hold short-term interest rates low for an extended period. In a speech in April, Governor Yellen stated the policy rate should, under present conditions, be held lower for longer. But how long is too long? The extended period of low rates is hurting individuals living on fixed income investments and defined benefit pension funds. The International Monetary Fund cautioned that the actions taken by central banks are associated with financial risks that are likely to increase the longer the policies are maintained. How would the Fed ensure that these risks are avoided under Dr. Yellen's chairmanship? In addition to unprecedented monetary policy, the next Fed chair will finalize several key financial regulatory reform rules. These rules must balance the financial stability with the inherent need for markets to take on and accurately price risk. They must be done without putting the U.S. markets at an undue competitive disadvantage or harming consumers with unintended consequences. The chair of the Federal Reserve must understand how different rules interact with each other, what impact they have on the affected entities and the economy at large. Just as some worried that we did not have enough regulations on the books to prevent the economic crisis, some of us worry now that the post-crisis response will result in a regulatory regime that stifles growth and job creation. The chair of the Federal Reserve must know and understand the need for that balance and how to carefully manage competing demands without harming the economy. The U.S. banking system and capital markets must remain the preferred destination for investors throughout the world. During previous hearings, I've asked Chairman Bernanke what parts of Dodd-Frank could be revisited on a bipartisan basis. The chairman identified the end user and swaps push-out provisions as well as the need for regulatory relief on small banks. Chairman Bernanke also commented in July that legislation is needed to allow the Fed flexibility to deal with the Collins Amendment and tailor appropriate capital requirements for insurance companies. I look forward to hearing Dr. Yellen's views on what Dodd-Frank fixes Congress ought to consider and how she intends to achieve an appropriate balance between the prudential regulation and economic growth, if confirmed. In addition to the previously mentioned issues, the makeup of the board itself will change in the near future. Governor Sarah Bloom Raskin has been nominated to a position at Treasury, and Governor Elizabeth Duke resigned in August. If Governor Yellen is confirmed as chair, the Fed will need a new vice chair. Moreover, Dodd-Frank created a vice chair of supervision, which has not yet been officially filled. These appointments will shape the direction of the Federal Reserve policy making for years to come. I look forward to working with the chairman to see that these positions are filled in a way that provides the proper balance and expertise at the Fed. Thank you, Mr. Chairman.
Thank you, Senator Crapo. Senator Crapo and I have agreed that to allow for sufficient time for questions, we're limiting opening statements to the chair and American member. All senators are welcome to submit an opening statement for the record. We will now swear in Dr. Yellen. Please rise and raise your right hand. Do you swear or affirm that the testimony that you are about to give is the truth, the whole truth, and nothing but the truth, so help you God? Do you agree to appear and testify before any duly constituted committee of the Senate?
I do.
Please be seated. Please be assured that your written statement will be part of the record. I invite you to introduce your family and friends in attendance before beginning your statement. Dr. Yellen, please proceed with your testimony.
Thank you. I would like to introduce my husband, George Akerlof, and my sister-in-law, Allison Brooks, and my friend and a former San Francisco Fed director, Carla Chambers, who are with me today. Chairman Johnson, Senator Crapo, and members of the committee, thank you for this opportunity to appear before you today. It's been a privilege for me to serve the Federal Reserve at different times and in different roles over the past 36 years, and an honor to be nominated by the President to lead the Fed as chair of the Board of Governors. I approach this task with a clear understanding that the Congress has entrusted the Federal Reserve with great responsibilities. Its decisions affect the well-being of every American and the strength and prosperity of our nation. That prosperity depends most, of course, on the productiveness and enterprise of the American people. But the Federal Reserve plays a role too, promoting conditions that foster maximum employment, low and stable inflation, and a safe and sound financial system. The past 6 years have been challenging for our nation and difficult for many Americans. We endured the worst financial crisis and deepest recession since the Great Depression. The effects were severe, but they could have been far worse. Working together, government leaders confronted these challenges and successfully contained the crisis. Under the wise and skilled leadership of Chairman Bernanke, the Fed helped stabilize the financial system, arrest the steep fall in the economy, and restart growth. Today, the economy is significantly stronger and continues to improve. The private sector has created 7.8 million jobs since the post-crisis low for employment in 2010. Housing, which was at the center of the crisis, seems to have turned a corner. Construction, home prices, and sales are up significantly. The auto industry has made an impressive comeback, with domestic production and sales back to near their pre-crisis levels. We've made good progress, but we have further to go to regain the ground lost in the crisis and the recession. Unemployment is down from a peak of 10%, but at 7.3% in October, it is still too high, reflecting a labor market and economy performing far short of their potential. At the same time, inflation is running below the Federal Reserve's goal of 2% and is expected to continue to do so for some time. For these reasons, the Federal Reserve is using its monetary policy tools to promote a more robust recovery. A strong recovery will ultimately enable the Fed to reduce its monetary accommodation and its reliance on unconventional policy tools such as asset purchases. I believe that supporting the recovery today is the surest path to returning to a more normal approach to monetary policy. In the past 2 decades, and especially under Chairman Bernanke, the Federal Reserve has provided more and clearer information about its goals. Like the chairman, I strongly believe that monetary policy is most effective when the public understands what the Fed is trying to do and how it plans to do it. At the request of Chairman Bernanke, I led the effort to adopt a statement of the Federal Open Market Committee's longer-run objectives, including a 2% goal for inflation. I believe this statement has sent a clear and powerful message about the FOMC's commitment to its goals and has helped anchor the public's expectations that inflation will remain low and stable in the future. In this and many other ways, the Federal Reserve has become a more open and transparent institution. I've strongly supported this commitment to openness and transparency, and I will continue to do so if I'm confirmed and serve as chair. The crisis revealed weaknesses in our financial system. I believe that financial institutions, the Federal Reserve, and our fellow regulators have made considerable progress in addressing those weaknesses. Banks are stronger today. Regulatory gaps are being closed, and the financial system is more stable and more resilient. Safeguarding the United States in a global financial system requires higher standards both here and abroad. So the Federal Reserve and other regulators have worked with our counterparts around the globe to secure improved capital requirements and other reforms internationally. Today, banks hold more and higher quality capital and liquid assets, that leave them much better prepared to withstand financial turmoil. Large banks are now subject to annual stress tests designed to ensure that they will have enough capital to continue the vital role they play in the economy, even under highly adverse circumstances. We have made progress in promoting a strong and stable financial system, but here too, important work lies ahead. I'm committed to using the Fed's supervisory and regulatory role to reduce the threat of another financial crisis. I believe that capital and liquidity rules and strong supervision are important tools for addressing the problem of financial institutions that are regarded as too big to fail. In writing new rules, however, the Fed should continue to limit the regulatory burden for community banks and smaller institutions, taking into account their distinct role and contributions. Overall, the Federal Reserve has sharpened its focus on financial stability and is taking that goal into consideration when carrying out its responsibilities for monetary policy. I support these developments and pledge, if confirmed, to continue them. Our country has come a long way since the dark days of the financial crisis, but we have farther to go. I believe the Federal Reserve has made significant progress toward its goals, but has more work to do. Thank you for the opportunity to appear before you today. I would be happy to respond to your questions.
Thank you for your testimony. Will the clerk please put 5 minutes on the clock for each member? Dr. Yellen, you know as I do that unemployment is not just numbers, but real men and women who are ready to work if given the chance. So as chair, how will you lead the Fed to continue reducing unemployment aggressively and improve the prospects of young Americans and others who are unemployed?
Thank you, Senator. I would be strongly committed to working with the FOMC to continue promoting a robust economic recovery. As you noted, unemployment remains high. A disproportionate share of that unemployment takes the form of long spells of unemployment. Around 36% of all those unemployed have been unemployed for more than 6 months. This is a virtually unprecedented situation. And we know that those long spells of unemployment are particularly painful for households, impose great hardship and costs on those without work, on the marriages of those who suffer these long unemployment spells, on their families. So I consider it imperative that we do what we can to promote a very strong recovery. We're doing that by continuing our asset purchase program, which we put in place with the goal of assuring a substantial improvement in the outlook for the labor market. We're taking account of the costs and efficacy of that program as we go along. At this point, I believe the costs exceed the benefits exceed the costs. As that program gradually winds down, we've indicated that we expect to maintain a highly accommodative monetary policy for some time to come thereafter. And the message that we want to send is that we will do what is in our power to assure a robust recovery in the context of price stability.
What are the dangers of tapering asset purchases too early? If confirmed, how should the FOMC move forward on an exit strategy?
So, Senator, I think that there are dangers, frankly, on both sides of ending the program or ending accommodation too early. There are also dangers that we have to keep in mind with continuing the program too long, or more generally, keeping monetary policy accommodation in place too long. So the objective here is to assure a strong and robust recovery so that we get back to full employment, and that we do so while keeping inflation under control. It's important not to remove support, especially when the recovery is fragile, and the tools available to monetary policy should the economy falter are limited, given that the short-term interest rates are at zero. I believe it could be costly to withdraw accommodation or to fail to provide adequate accommodation. On the other hand, it will be important for us also, as the recovery proceeds, to make sure that we do withdraw accommodation when the time has come. My colleagues and I are committed to our longer-run inflation goal of 2%, and we will need to ensure that as the recovery takes hold and progresses, that we will also exit or bring monetary policy back to normal in a timely fashion. I believe we have the tools absolutely to do so. We have been very careful to make sure that we have the tools available at our disposal, and we also have the will and commitment, and I look forward to leading, when the time is appropriate, the normalization of monetary policy.
Thank you. Senator Crapo.
Thank you, Mr. Chairman, and I'd like to follow up on the Chairman's question with you, Ms. Yellen, with regard to quantitative easing. And you've indicated that you feel that as long as the economy remains, well, I don't want to put words in your mouth, but as the economy remains fragile, that we need to continue the accommodation from the Federal Reserve. According to the July quarterly survey of the primary dealers by the New York Fed, the Fed's balance sheet will reach almost 24% of GDP in the first quarter of 2014. And I'm concerned about the size of the Fed's balance sheet and its impact on the economy and the unintended consequences of these accommodations. It seems to me that there's a disconnect between what the Fed intended to accomplish and the results. A PIMCO executive recently stated that the $4 trillion in quantitative easing may have contributed as little as 0.25% to GDP growth. And even the Fed's own economists estimate that the QE2 added only about 0.13% to real GDP growth in 2010, and another expert has indicated that Fed policies contribute to bubble-like markets. How do you respond to the concerns that quantitative easing has limited impact on economic growth and is in fact creating very serious risks in our financial markets?
So a number of different studies have been done attempting to assess what the contribution of our asset purchases have been. And of course, this is something we can only estimate and can't know with certainty. But my personal assessment would be, based on all of that work, that these purchases have made a meaningful contribution to economic growth and to improving the outlook. Certainly, long-term interest rates, the purpose of these purchases was to push down longer-term interest rates. We have seen interest rates fall very substantially. Lower interest rates, lower mortgage rates particularly, I think, have been instrumental in, it's not the only factor, but it has been a positive factor in generating the recovery of the housing sector. House prices, after having fallen very substantially, are moving up, and I think that's helping substantially many households, including the large fraction of American households who found themselves underwater on their mortgages. It's improving their household finances. I think we've seen a very meaningful recovery in automobile sales, spurred in part, again, other factors play a role, but also by low interest rates.
But how long can we artificially hold or operate monetary policy in such, what I consider to be such extreme levels of the quantitative easing?
So, Senator, when we initiated this program, the unemployment rate was 8.1%, and the committee was somewhat pessimistic about its expectations for what we would see in the labor market over the ensuing year. In fact, the committee expected little or no meaningful progress in bringing down unemployment. And when we began this program, we indicated that our goal was to see a substantial improvement in the outlook for the labor market. So the progress of this program, it's not on a set course, it is data dependent, but we have seen improvement in the labor market.
But can it just continue indefinitely? I mean, if the labor market doesn't improve to the point that you reach your target, how long can this continue? Do you agree that there has to be some point at which we return to normal monetary policy?
So I would agree that this program cannot continue forever, that there are costs and risks associated with the program. We're monitoring those very carefully. You noted potential risks to financial stability, and those are risks that we take very seriously. The committee is focused on a variety of risks and recognizes that the longer this program continues, the more we will need to worry about those risks. So I do not see the program as continuing indefinitely.
Do you have any estimate right now as to when there may be a beginning of the tapering?
Well, we, at each meeting, are attempting to assess whether or not we have seen meaningful progress in the labor market, and what the committee is looking for is signs that we will have growth that's strong enough to promote continued progress. As the FOMC indicated in its most recent statement, we do see strength in the private sector of the economy, and we are expecting continued progress going forward. So while there's no set time that we will decide to reduce the pace of our purchases, at each meeting we are attempting to assess whether or not the outlook is meeting the criterion that we've set out to begin to reduce the pace of purchases.
My time's expired. Thank you.
Senator Menendez.
Well, thank you, Mr. Chairman. Thank you, Dr. Yellen. I appreciated our visit together. Let me ask you, as the Federal Reserve has engaged in measures to strengthen our economy, some critics have argued that any growth that results might somehow be artificial. I know we've heard that here. Or that low interest rates and cheaper credit might lead to financial instability or asset bubbles if investors make riskier investments in order to, quote, reach for the yield. In the current environment, though, my question is, isn't weak demand the greater concern? And I look at consumers pulling back on their spending because of high debt burdens, underwater mortgages from the financial crisis, businesses holding off on investing because of weak consumer demand. Doesn't that change the relative costs, benefits, and risks of different monetary policy actions?
Well, Senator, I completely agree that weak demand for the goods and services that this economy is capable of producing is a major drag holding back the economy. And of course, the purpose of our policies, all of them, are to bring down interest rates in order to spur spending in interest-sensitive sectors. And if we're capable of doing that, that will help to stimulate a favorable dynamic in which jobs are created, incomes rise, more spending takes place, and that creates more jobs throughout the economy. So I agree with your diagnosis, and our programs are intended to remedy the situation of weak demand. On the other hand, it is very important for us to monitor financial risks that could be developing as a consequence of the program or of low interest rates more generally, or even more broadly of developing financial risks in the economy. No one wants to live through another financial crisis, and the Federal Reserve is devoting substantial resources and time and effort at monitoring those risks. At this stage, I don't see risks of financial stability, although there is limited evidence of reach for yield. We don't see a broad buildup in leverage or the development of risks that I think at this stage poses a risk to financial stability.
Well, let me ask you, I appreciate that. Some commentators have suggested that in addition to managing inflation and promoting full employment, the Fed should also monitor and attempt to fight asset bubbles. Do you think it's a feasible job and something that the Fed should be doing? And if so, how would you go about it?
Well, Senator, I think it's important for the Fed, hard as it is, to attempt to detect asset bubbles when they're forming. We devote a good deal of time and attention to monitoring asset prices in different sectors, whether it's house prices or equity prices or farmland prices, to try to see if there is evidence of price misalignments that are developing. By and large, I would say that I don't see evidence at this point in major sectors of asset price misalignments, at least of a level that would threaten financial stability. But if we were to detect such misalignments or other threats to financial stability, in my view, I would like, as a first line of defense, we have a variety of supervisory tools, micro and macro prudential, that we can use to attempt to limit the behavior that is giving rise to those asset price misalignments. I would not rule out using monetary policy as a tool to address asset price misalignments, but because it's a blunt tool and because Congress has asked us to use those tools to achieve the goals of maximum employment and price stability, which are very important goals in their own right. I would like to see monetary policy first and foremost directed toward achieving those goals Congress has given us, and to use other tools in the first instance to try to address potential financial stability threats. But an environment of low interest rates can induce risky behavior, and I would not rule out monetary policy conceivably having to play a role.
Thank you. Thank you, Mr. Chairman.
Senator Shelby.
Thank you. Welcome, Governor. Would you describe the portfolio of the Federal Reserve as unprecedented, the size of it today?
Yes, Senator.
You're an economist, and you've been on the Fed, and you were also the chairman of the Economic Advisors to President Clinton. Have you, looking back in history, recent history, the last 30, 40, 50 years, have you noticed any portfolio of the Fed approaching what it is today?
Not of the Federal Reserve.
That's what I mean.
But other central banks.
I'm asking about the Federal Reserve of the United States of America.
No, I have not, Senator.
Okay. Would you describe what you're doing here by, you call it quantitative easing, a term that's been made up, I guess. We all make up terms. But is that a stimulus toward the economy, a tool? You use the word, the term monetary tool. Is that what you would call it, to help augment, to stimulate the economy?
It is a tool that is intended to push down longer-term interest rates.
Yes, ma'am. I understand that.
And to stimulate demand and spending in the economy, yes.
Is this in the area of economics something that Keynes and Tobin and others have espoused over the years at times when you've got high unemployment? To use a monetary tool to stimulate the economy?
Well, Tobin and Friedman and others
What
have...
about Keynes, too?
I don't know if the Keynes actually thought about this,
Okay.
but a number of economists have written about something called the portfolio balance effect. It's basically about supply and demand, that by buying up a class of assets, that it may be possible to push up their prices and push down their yields and thereby affect financial conditions in the economy.
You know, it was said several years ago that China was buying our bonds. In other words, we were totally dependent on China to buy our paper, finance our deficits, and so forth. But isn't it true that the Federal Reserve in the last, since you had quantitative easing, is basically the buyer of our bonds, our paper?
Well, Senator, we're purchasing...
For the most part.
We are purchasing a substantial, at this point, quantity of both Treasury and mortgage-backed, agency mortgage-backed securities, but we're certainly not doing so for the sake of helping the government finance the deficit. We're doing so to achieve the goals that Congress has assigned to the Federal Reserve in circumstances where we've run out of scope for conducting additional normal monetary policy once our overnight interest rate target has hit zero. We really have to rely on alternative techniques, and we're certainly not the only central bank that has recognized this and undertaken similar programs.
Now, you alluded to other central banks, but of course you look around the world, and I don't know of any central bank that I think we should follow myself, and a lot of economists don't, but we should set the example here in the United States, and the Fed has historically. I'll run out of time in a minute. Unemployment, you mentioned unemployment. Stated unemployment's what, 7.2 or 3%?
7.3.
What is the real unemployment? That is, people that have given up looking for a job, working part-time, are frustrated by the whole system. Is it around 13, 14%?
Well, Senator, you're absolutely right that broader measures of unemployment are much higher. Part-time employment among people who would prefer full-time jobs or more work are at unprecedented levels, and we've seen a significant decline in labor force participation. Part of it reflects, is probably voluntary, reflects an aging workforce, but some of it may be a reflection of very weak labor market conditions where people who've been unemployed for a long time feel frustrated about their job prospects.
Could you quickly mention your views on Basel III, how important Basel III is, how important it is for our banks to make the standards of capital and liquidity, and also the other banks in Europe? How important is that?
Senator, it's extremely important for our banks to have more capital, higher quality capital. Basel III, putting those rules into effect, has been an important step, and there are further steps that we will be taking with other regulators down the line to make sure that the most systemically important institutions, those whose failure could create financial distress, will be asked to hold more capital and meet higher standards of liquidity and prudential supervision to make sure that they are more resilient.
What have you learned since you were president of the San Francisco Bank? You were there during the housing bubble and in the debacle. As a regulator, I hope that you and others have learned a lot. You're not just the Federal Reserve, but others, that you can't let a bubble continue to grow.
Senator, I think in the aftermath of the crisis, all of us have spent a great deal of time attempting to draw the appropriate lessons. There have been many of them. The Federal Reserve is very focused on a broad financial stability mandate, both in terms of our monitoring of the economy, attempting to understand the threats that exist broadly in the financial system, and to improve our supervision, especially of the largest institutions, to make sure that we're identifying those threats that can be risks to the economy.
Thank you.
Senator Brown.
Thank you, Mr. Chairman. Welcome, Ms. Yellen. When Chairman Bernanke came before this committee 3.5 years ago, he noted that the two sectors that typically pull us out of recession, housing and manufacturing, the Fed's monetary policy through large-scale purchases of mortgage-backed securities clearly aimed at stimulating and promoting housing. You have spoken compellingly about the real economy. I hope that means a real emphasis on manufacturing, particularly because its impact rippling through the entire economy. But one of my concerns is that the Fed's monetary policy doesn't do enough to serve all Americans. Last year, a journalist described the execution of monetary policy as a sort of trickle-down economics. It boosts the price of assets like stocks and bonds and in homes and can enrich the wealthy in Wall Street. But it's not clear to me, and more importantly, it's not clear to the many Americans who have not seen a raise in a number of years, that this policy increases wages and incomes for workers on Main Street. During your time as chair, tell us how you will ensure that the Fed's monetary policy directly benefits families on Main Street and places like Cleveland and Mansfield, Ohio.
Well, Senator, the objective of our policy is to broadly benefit all Americans, especially those who are seeing harm come to them and their families from high unemployment, in a recovery that's taken a long time and been frankly disappointing. It's true that in the first instance, the policies that the Fed conducts when we implement monetary policy drive down interest rates, affect asset prices, and you use the term trickle down. We tend to affect interest-sensitive spending, automobiles, housing, but the ripple effects go through the economy and bring benefits to, I would say, all Americans, both those who are unemployed and find it easier to get jobs as the recovery is stronger, and also to those who have jobs. You mentioned that wage growth has been weak or non-existent in real terms over the last several years. As the economy recovers, my hope and expectation is that that would change, and if we can generate a more robust recovery in a context of price stability, that all Americans will see more meaningful increases in their well-being.
Thank you. As my role in this committee, spent a lot of time talking to bankers, to community bankers, to the regionals like bankers at Key and Huntington and PNC and Fifth Third and some of the largest 6 or 7 or 8 banks, and I hear a concern from so many of these bankers across the board that too big to fail is still hasn't been solved. In March, Chairman Bernanke said, too big to fail is not solved and gone. It's still here. Last Friday, you, I'm sure, saw the comments of the president of the New York Fed, Bill Dudley, not exactly a populist firebrand. He said that there are deep-seated cultural and ethical failures at many large financial institutions. Quote, they have an apparent lack of respect for law, regulation, the public trust. He said our current regulatory efforts may not solve these problems. His views reinforced by the fact that DOJ currently has 8 separate investigations open against the largest U.S. banks alone. Do you agree with what I assume you're hearing from bankers too, and from others, and do you agree with Chairman Bernanke and Mr. Dudley that a system where too big to fail institutions have, in Dudley's words, an apparent lack of respect for law, regulation, the public trust? Do you agree we haven't solved the problem? And what do you do as Fed chair to address too big to fail?
Senator, I would agree that addressing too big to fail has to be among the most important goals of the post-crisis period. That must be the goal that we try to achieve. Too big to fail is damaging. It creates moral hazard. It corrodes market discipline. It creates a threat to financial stability, and it does unfairly, in my view, advantage large banking firms over small ones. My assessment would be that we are making progress, that Dodd-Frank put into place an agenda that, as we complete it, should make a very meaningful difference in terms of too big to fail. We've raised capital standards. We will raise capital standards further for the largest institutions that pose the greatest risk by proposing so-called SIFI capital surcharges. We have on the drawing boards the possibility of requiring that the largest banking organizations hold additional unsecured debt at the holding company level to make sure that they are capable of resolution. Right now, the FDIC has the capacity and the legal authority to resolve, possibly using orderly liquidation authority, a systemically important firm that finds itself in trouble. And they've designed an architecture that I think is very promising in terms of being able to accomplish that. So we are working with foreign regulators to improve the odds of a successful resolution, and continuing to put in place higher prudential standards, capital and liquidity requirements. We've put out a proposal for a supplementary leverage requirement for the largest banks. So I think that this agenda will make a meaningful difference, and we're hoping to complete this in the months ahead.
You said you look for something potentially, something maybe to do further. How will you assess the regs put out, the higher capital standards by the Fed, the OCC, and FDIC? How will you assess as they go into effect if you need higher capital requirements, not just certainly the surcharges, but how will you assess the effectiveness of those?
There are, as you know, studies that attempt to estimate what the too big to fail subsidy is in the market. And while there are a lot of question marks around those studies, we can look to see what's happening there.
Do you believe there is a subsidy, as Bloomberg?
With the senator, wrap it
I
up.
apologize. Okay, that's the last question. Do you believe there's a subsidy, as Bloomberg and so many others have pointed out, of the tens of billions of dollars a year for the largest banks?
So I think there are different methodologies that are used in different studies, and it's hard to be definitive. But yes, I would say most studies point to some subsidy that may reflect too big to fail, although other factors also may account for part of the reason that larger firms tend to face lower borrowing costs.
Thank you. I'm sorry, Mr. Chairman.
Senator Britter.
Thank you, Mr. Chairman. Thank you, Dr. Yellen. I want to pick up where my colleague left off because, as you know, I share his and many others' concerns about too big to fail being alive and well. As both of you noted, there are many studies that document, even try to measure too big to fail and the market subsidy or advantage that the mega banks have. Another is coming out today. GAO is releasing its first study that Senator Brown and I asked for, and again confirms this in general. It focuses on the huge discount that the Federal Reserve offered the mega banks during the financial crisis and the huge market advantage that they got. And specifically, this GAO report coming out today said, quote, it recommended, quote, the Federal Reserve Board finalize policies and procedures related to its emergency lending authority and establish internal timelines for developing those procedures to ensure timely compliance with Dodd-Frank Act requirements, close quote. What that means really is Dodd-Frank gives you the ability to wind down that emergency lending authority. The board has not acted on that or even established, as far as I know, internal timelines to do that. So one obvious question related to this study coming out today, will you do that as chairman, and when will you do it?
Senator, I think that guidance is in the works, and we will try to get it out soon.
Do you have a general time frame in mind?
I'm not certain just what the time frame is, but I will try to make sure that happens.
If I could just ask you to supplement the record following the hearing with more specifics about the Fed's plan to act on Dodd-Frank with regard to that. Thank you. You also mentioned increased leverage ratios for the biggest banks. I agree that the action you supported in July in terms of supplementary leverage ratio for larger banks was very positive. I do not agree that it's enough, and I think even when you consider the SIFI surcharge and other things, more needs to be done. Would you support going further in terms of leverage ratios for the largest banks or not?
So I think we will have a very meaningful improvement in capital standards by going the approach that Dodd-Frank has recommended, which is higher risk-based capital standards. There will be a SIFI surcharge. We're contemplating a counter-cyclical capital surcharge that would add to that. We are contemplating additional ways of dealing with problems of reliance on short-term wholesale funding that could take the form of a capital charge that's related to reliance on that kind of funding, or it could take the role of margin requirements. I think a belt and suspenders kind of approach in which we have a leverage requirement that serves as a backup because there are potential issues with risk-based capital requirements. Remember that we also have stress tests, which are yet another approach to assessing whether or not the largest systemically important institutions have the wherewithal to be able to lend.
And if I don't mean to cut you off, but if I can follow up before my time is up, I understand those other categories, including the SIFI surcharge, but considering all those, including the SIFI surcharge, I personally and others think you should go further with the supplementary leverage ratio. Would you support that as we speak today or not?
Oh, I would want to see where we are when we've implemented all of the Dodd-Frank requirements that we need to put in place.
Okay. Final question. You've said in the past, quote, like Chairman Bernanke, I strongly believe that monetary policy is most effective when the public understands what the Fed is trying to do and how it plans to do it, close quote. A lot of us would agree with that, and many of us think the best way to get there is through true openness and transparency at the Fed, not just a better sort of managed PR campaign, but real openness and transparency. Would you publicly support S-209? I'm sure you're familiar with that. And if not, what specific changes to that would be required to earn your public support?
So I strongly, as I've indicated, support transparency and openness on the part of the Fed. And I think with respect to monetary policy, in terms of the range of information and the timeliness of that information, we are one of the most transparent central banks in the world. What I would not support is a requirement that any requirement that would diminish the independence of the Federal Reserve in implementing and deciding on implementing in monetary policy. For 50 years, Congress has recognized that there should be an exception to GAO ability to audit the Fed to avoid any political interference in monetary policy. I believe it's critically important to the economic performance of this country, and we've seen this around the world, that allowing a central bank to be independent in formulating monetary policy is critical to assuring markets and the public that we will achieve price stability. And I would be very concerned about legislation that would subject the Federal Reserve to short-term political pressures that could interfere with that independence.
Thank you, Mr. Chairman.
Senator Tester.
Yeah, thank you, Mr. Chairman. I want to thank you for being here, Vice Chair Yellen. At the end of October, the Federal Reserve formally applied for application in the Insurance Association, International Association of Insurance Supervisors, for membership. The United States already has membership on that through the Federal Insurance Office created by Dodd-Frank. Can you tell me why the Fed should have membership, its own membership on that board, and furthermore, why there should be a focus on that when domestic oversight challenges seem to be a much higher priority?
Well, my understanding, Senator, is that now that the Federal Reserve has been charged with supervising some of the largest insurance companies that have been designated by FSOC as systemic, that we want to be in a position to work with regulators in other countries, as we have in the case of banking rules, to make sure that we have internationally compatible
And the FIO,
standards.
excuse me, but the FIO cannot fill that need for you?
I'm not certain. I think we felt it would be beneficial to participate in that group.
Okay. In our conversations about ensuring capital standards appropriately tailored to insurers, I have raised concern in the same vein that with the FSOC, who I have encouraged to develop industry-specific guidance and metrics for systemically important financial institutions. Do you agree that the FSOC has and should exercise its authority to develop industry-specific guidance and metrics rather than forcing insurers or asset managing firms, for example, into a bank-centric regulatory model?
So, Senator, I do believe that one-size-fits-all should not be the model for regulation, and that we need to develop appropriate models for regulation and supervision of different kinds of institutions. Insurance certainly has some very unique features that make them very different from banks, and we're taking the time to try to study what the best way is to craft regulations that would be appropriate for those organizations.
And so what I'm hearing you saying is that a bank-centric regulatory model would not work for insurance companies in this country?
Well, there certainly are critical differences in terms of their business models that we want to understand and respond to.
Okay. I want to express a serious disappointment with a recent decision by FSOC not to release for public comment a study produced by the Office of Financial Research regarding the asset management industry. While the Council has publicly indicated that it would release any metrics or guidance on this industry for public comment, it has declined to release this study, which will presumably be a formal basis for future consideration. If you are confirmed as Chairman of the Fed and a member of the FSOC, will you ensure that the Council lives up to its commitment of transparency? And will the Fed support efforts to make any potential evaluation metrics and studies on which they may be based available for public comment?
So, Senator, I have not participated in FSOC, but if I do so, I will try to take those concerns seriously.
If you're confirmed, you will be participating in FSOC.
I will.
And the question is about transparency, and it's the transparency of metrics that are going to be used that people need to have the ability to comment on before they're applied. And I guess my question to you is will you be willing to make that commitment to transparency as it applies to the FSOC?
So I will need to study this issue more closely in terms of what FSOC's procedures are, but I feel it should be clear why a particular firm has been designated if that occurs.
And the metrics that they're using for that designation. Okay. In closing, I just want to say thank you for your willingness to work on the end user issue that we discussed last week. I very much appreciate it. Thank you, Mr. Chairman.
Senator Kirk.
Technical question on behalf of large insurance employers in Illinois to extract a commitment from you to do a cost-benefit analysis if we are to require them to switch from SAP to GAAP accounting, which they have warned me could cost a couple $100 million.
So, Senator, I'm aware that there is an issue around different accounting standards in insurance companies. I haven't had a chance to study that myself, but I would certainly agree that this is something that we need to look into and to consider very carefully and pledge to do so.
Thank you, Dr. Yellen. Mr. Chairman, thank you.
Senator Warner.
Thank you, Mr. Chairman, and thank you, Dr. Yellen, for being here. I want to got a series of quick questions. Well, one, I guess I'd like to make a comment. I understand some of our colleagues' concerns about some of the extraordinary measures the Fed has had to take on quantitative easing. I guess I would simply make a comment and ask for a short response on this, that part of our political dysfunction in this town in terms of the ability to actually grapple with getting our country's balance sheet right in terms of the so-called grand bargain or even an actual budget in place. If we were able to actually perform our functions, wouldn't that allow you to move out of these extraordinary measures in a quicker manner?
Well, Senator, it's certainly the case that the economy has suffered over the last year a substantial drag from fiscal policy. The CBO estimates that the drag amounts to something like 1.5% on growth. And as we commented in our FOMC statement most recently, taking account of that large amount of fiscal drag, the economy, even though it's only been growing around 2%, is showing greater momentum. So I think it's fair to say, and I would expect, that if there were less fiscal drag, and I hope there will be less going forward, that the economy's growth rate is going to pick up. So certainly that's been a headwind on the economy and something that we've tried to offset, but obviously our tools to do so, it's not perfect, not
right.
easy
And
to do
obviously,
so.
government shutdowns, which cost the latest estimate $24 billion, or potential default threats, which result in spikes of interest rates, sure as heck don't provide that predictability. I want to actually follow up as well with where Senator Tester left off. I have to say, as someone, along with my friend Senator Corker, were very involved in Title I and Title II, I've been personally disappointed in the FSOC's ability to kind of be that interagency arbiter around regulatory conflicts. I've also been somewhat disappointed with the actions so far of the OFR, and I simply would say I think it is I hope as you move into this role on the FSOC, there will be financial institutions, non-bank financial institutions that will be SIFIs. Senator Tester mentioned asset management firms. It did seem to me as well that the OFR's report didn't have a lot of collaboration, didn't have a lot of clarity, and I would hope that in your role on the FSOC, and again, I think one of the reasons why I wish we would have ended up with an independent chair on the FSOC, but you will clearly have an outsized role as the Fed representative, that we try to give some clarity that we don't think we're going to view everything through a bank-centric regulatory prism, that we realize as we look at non-bank institutions that maybe require that SIFI designation, that we give some clarity about how we're going to evaluate those non-bank institutions.
I think that's completely fair and a very reasonable and logical objective for FSOC to have. Our staff have been working very closely with FSOC and the OFR and trying to, participate constructively and facilitate the works of those groups.
Well, I would just add my voice to Senator Tester's that we'd like to see that transparency as we start to evaluate non-bank institutions for SIFI designation, so we kind of all know the rules going forward. I think that would be helpful. One of the things that as we think about balance sheets and stimulation of or getting more private capital lent, one of the things I know that the Fed pays interest on excess reserves of the banks. What I believe now you're holding about $2.4 trillion of those banking excess reserves, and I think we pay 25 basis points. We've seen other central banks, I think Denmark and others, start to lower those payments. Would you consider that possibility of, in effect, incenting the banks to get this capital not on your balance sheet, but back out into the marketplace to stimulate more loans and more private capital into the market?
So, Senator, that is something that the FOMC has discussed and the board has considered on past occasions, and it is something we could consider going forward. I think our assessment, we've worried that if we were to lower that rate too close to zero, we would begin to impair money market function, and that's been a consideration on the other side, but it certainly is a possibility, Senator.
I just say I'd ask you to look at this as well, because it's one of the ways without necessarily growing your balance sheet that some of my colleagues have expressed concern with. Thank you.
Thank you, Senator.
Senator Heller.
Thank you, Mr. Chairman. And Dr. Yellen, thank you very much for being here today. And I also want to thank your family also for taking time and showing their support. I think that makes a real difference. Question, do you follow gold prices?
To some extent.
Do you believe there's any economic indicator behind the rise and fall of gold prices?
Well, I don't think anybody has a very good model of what makes gold prices go up or down, but certainly it is an asset that people want to hold when they're very fearful about potential financial market catastrophe or economic troubles and tail risks. And when there is financial market turbulence, often we see gold prices rise as people flee into them.
Well, that was a better answer than I got from Chairman Bernanke last July. I asked him the same question, and he said that nobody really understands gold prices. And he went on to say, and I don't pretend to really understand them either. And do you share that view, or clearly with a few extra tidbits that you just shared with us?
I think beyond what I shared, I don't have strong views on what drives them. I haven't seen a lot of models that have been successful in predicting them.
Thank you. You talked in your general statement at the beginning about the role of the Federal Reserve, promoting conditions that foster maximum employment, stable, low and stable inflation, safe and sound financial system. Do you believe we have a safe and sound financial system today?
I think we have a much safer and sounder financial system than we had pre-crisis. But as I indicated, I think we need to do more. We are not at the end of the road in terms of putting in place regulations and enhanced supervision that will make the system safe and sound as it needs to be to contain systemic risk.
The reason I raised the question is we had this discussion when you were in my office about community banks, and sitting as chairwoman of the San Francisco Federal Board, you have a pretty good understanding of what's going on out west, California, Nevada. And as you're aware of, and as I shared with you, we've lost half of the community banks and credit unions in our communities, making it very, very difficult for choices, making it very difficult for housing recovery, getting loans for small businesses. I guess the question is, what steps will you take to avert a culture of consolidation of these major banks and the loss of the small community banks?
Well, Senator, in the first place, to the extent that the large banks have an advantage because they benefit from a too-big-to-fail subsidy, I think our objective in regulation should be to put in place tough enough regulations and capital and liquidity standards that we level the playing field and make it costly, since those firms do pose systemic risk to the financial system. We should be making it tougher for them to compete and encouraging them to be smaller and less systemic. And with respect to the community banks, we need a model for supervision of them that's different and much less onerous and has much less regulatory burden and is appropriate to their business model. We're obviously imposing on the largest systemic institutions much higher and more onerous prudential standards.
And I appreciate your comments, because I do believe the one-size-fits-all is what's really at a disadvantage for the community banks and these smaller banks. Quick question about quantitative easing. Do you see it causing an equity bubble in today's stock market?
I mean, stock prices have risen pretty robustly, but I think that if you look at traditional valuation measures, the kind of things that we monitor akin to price equity ratios, you would not see stock prices in territory that suggests bubble-like conditions. When we look at a measure of what's called the equity risk premium, which is the differential between the expected return on stocks and safe assets like bonds, that premium is not is somewhat elevated historically, which again suggests valuations that are not in bubble territory.
Do you believe there's a federal role to support the stock market?
A federal role to support the stock market? No.
Thank you. Thank you, Mr. Chairman.
Senator Berkeley.
Well, thank you, Mr. Chair, and thank you, Dr. Yellen. And I don't believe any nominee for this position has come with such an extensive set of qualifications. And it's fascinating to read the diversity of your writings over the last 4 decades. I wanted to give a special welcome to Carla Chambers, who represented Oregon very well on the board of directors of the Federal Reserve Bank of San Francisco. A number of issues have arisen in the international banking community just since the meltdown in 2008, including LIBOR rate manipulation, energy market manipulation, the London whale, massive issues related to money laundering, robo-signing fraud on foreclosure documents. The Fed plays an important role in regulation and supervision. Can the Fed, under your leadership, help restore public faith in our regulatory system?
Senator, I feel that that's an exceptionally important goal and one that I'm happy to espouse and work toward. I absolutely feel that that's essential and appropriate. Yes.
Thank you very much. And second, I wanted to ask you to address the rules that are being completed on the Volcker rule or firewall, which creates a wall between hedge funds that make risky bets with funds from private investors and commercial banks that have insured deposits and access to the discount window and play an essential role in providing loans to individuals and businesses. There's been a lot of concern that this firewall will be compromised with loopholes related to liquidity management, portfolio hedging, and market making. Can we count on the Fed under your leadership to work with the other regulators to produce a strong Volcker rule? And perhaps it will be completed before you're there, because they're in the final stages. But if so, to implement it in a fashion that keeps faith with this goal of reducing systemic risk by keeping the commercial banking world in the commercial banking sphere.
Yes, Senator, we're working very closely and I believe constructively on this rulemaking with the other agencies. We are certainly trying to be faithful to the intent of this rule, which is to eliminate short-term financial speculation in institutions that enjoy the protection of the safety net. The devil here is in the details. The rule does permit appropriate hedging in market-making activities, and we're trying to devise a rule that will permit those activities, but absolutely be faithful to the intent that Congress had here.
Thank you. And third, I wanted to ask you to ponder an issue that received considerable attention regarding commodities, and the concern that under a certain situation, large banks available put their thumb on the scale through their ownership of electric power generation facilities, pipelines, oil tankers, warehouses for key metals. And there is certainly a history in terms of Gramm-Leach-Bliley, in terms of grandfathered commodity investments, and in terms of related activities. But there is concern that the ability to influence supply and demand and affect price, while at the same time as having the ability to make bets on the price, creates a conflict of interest that provides essentially a hidden tax on the American economy. And the Fed does have regulatory powers related to this, and can you maybe chew on this a little bit in terms of your perspectives?
So, Senator, we're involved in a very comprehensive review of commodities activities in financial holding companies. As you indicated, we allowed some activities that we deemed to be complementary to financial activities, and we're reviewing what is appropriate there. In addition, Congress, as you noted, grandfathered certain activities in firms that later became financial holding companies. We want to make sure that these are conducted in a safe and sound manner, and we may be involved in additional rulemaking as we complete this review. With respect to market manipulation, I would just note, though, that it's the role and responsibility of market regulators, particularly the CFTC here, to be looking into possibilities of market regulation. Our main job, and we would certainly cooperate in any look there, our main role is prudential and safety and soundness.
Well, thank you so much for being willing to consider taking on this role at the Fed and bringing your expertise to bear and your past public service, and I certainly wish you well. Thank you.
Thank you, Senator.
Senator Corker.
Thank you, Mr. Chairman, and Dr. Yellen, thank you for being here, and I appreciate the time in our office and your transparency here today. And just for the committee's record, if you would, share with all of us how many rate increases you have voted for during your term on the Federal Reserve.
So I served as a governor from 1994 to 97, and we had a cycle of rate increases during that time.
If you could just give me the number so I can press
I believe 20 or more.
20 or more. I think it was maybe 27 or so.
It could be.
And how many have you voted against?
None.
Okay. I thought that was just good to get into the record, and I appreciate you very much for being here. We talked a little bit about monetary policy, and maybe more than a little bit in the office, and I think one of the things that we discussed was my concern, and I think yours too, that in many ways easy money is a an elitist policy. I mean, it's the ultimate trickle down in that, you know, it's based on the premise that you're going to have this wealth creation. And what we've seen, obviously, is the largest Wall Street institutions have done the best, and that fund managers have made a lot of money, but it really hasn't trickled down to the economy. And as you were mentioning earlier, it's a blunt object. Would you agree that while it has been an attempt to stimulate the economy, the more well-off have benefited much better than those at the lower end of the spectrum?
Well, to the extent that low interest rates do have an impact on asset prices, these policies have probably to some extent boosted the stock market, which may be an example of what you're talking about, but it's also played an important role, I think, in helping the housing sector and boosting housing prices. And I think this is something that has been broadly beneficial to all those Americans who own homes, and has improved their financial sense of financial well-being, and that's broad-based.
Yeah. We talked a little bit about the Fed in the early summer, began to talk about moderating the pace at which it was going to be making purchases. And the market had a pretty stringent reaction. It was like, and the Federal Reserve appeared as if it had touched a hot stove, and that this policy was going to greatly affect, if you will, the wealth effect that you were trying to create, the policy of moderating. And so the Fed jumped back. And it seemed to me, and I think you discussed this a little bit in the office, that the Fed had become a prisoner to its own policy, that to really try to step away from QE3 was really going to shatter possibly the markets and therefore take away from the wealth effect. And I wonder if you could talk a little bit about some of the discussions that were taking place during that time.
Well, Senator, I don't think that the Fed ever can be or should be a prisoner of the markets. Our job
But to a degree in this case, it did affect the Fed, did it not?
Well, we do have to take account of what's happening in the markets, what impact market conditions are likely to have on spending and the economic outlook. So it is the case, and we highlighted this in our statement, when we saw a big jump in rates, a jump that was greater than we would have anticipated from the statements that we made in May and June, and particularly saw mortgage interest rates rise in the space of a few months by over 100 basis points. We had to ask ourselves whether or not that tightening of conditions in a sector where we were seeing a recovery, and a recovery that could really, a recovery in housing that could drive a broader recovery in the economy, we did have to ask ourselves whether or not that could potentially threaten what we were trying to achieve. But overall, we are not a prisoner of the markets. I continue to feel that we're seeing an improvement in the labor market, which was the goal of the program, and we'll continue to evaluate incoming data and to make decisions on the program and that like going forward.
Thank you. I'm just a little bit of a prisoner, maybe not fully. I understand. I would just, my last question is, you talked a little bit about monitoring sort of the financial markets, and I know that it's, again, monetary policy is a blunt instrument. I know that you've been credited with, back in 2005, signaling that the housing market was bubbling, if you will, in that part of the country. I guess my question is, do you believe that under your leadership, the Fed would have the courage to, when it saw asset bubbles, even though you only have blunt instruments, and I realize that, would it have the courage to actually prick those bubbles and ensure that we didn't create another crisis?
No one, Senator, no one who lived through that financial crisis would ever want to risk another one that could subject the economy to what we're painfully going through and recovering from. And we have a variety of different tools that we could use if we saw something like that occur. They include tools of supervision,
Right.
and monetary policy
And
is a
you would have the
possibility.
courage to do that.
I believe that I would, and I believe that this is the most important lesson learned from the financial crisis, Senator.
Mr. Chairman, thank you for having this hearing. And Dr. Yellen, I do want to tell you, I very much appreciate your candor and transparency. And I really do. I appreciate the conversation both in the office, and I want to thank you for giving the same answers to questioners here today that you gave in the office. So thank you very much.
Thank you very much, Senator. Appreciate that.
Senator Hagan.
Thank you, Mr. Chairman. Thank you, Ranking Member Crapo. And I want to echo what I'm sure everybody's stated is the depth of your background, your experience, your expertise, and we're very honored to have you here. And thanks for your testimony. I wanted to talk about the Section 716 in Dodd-Frank. And in that section, it is required that banks with access to deposit insurance as well as, or the Federal Reserve discount window, to push out certain plain vanilla derivatives such as equity and commodity-based swaps to push them out to separately capitalized affiliates. This move would raise costs to the end users without significantly reducing risk to the financial system. When I've spoken with Chairman Bernanke, and he has consistently stated that the Federal Reserve had concerns about the swaps push-out rule prior to the enactment of Dodd-Frank, and that they still have concerns about it today. Are your views on this issue consistent with Chairman Bernanke's, and would you share the view that it's a good idea to repeal parts of the swaps of the push-out rule? And then, if that did not take place, what would be what would the markets do then?
So, Senator, as you indicated, the Federal Reserve and other agencies did have concerns about this rule, and they expressed them when Dodd-Frank was being considered. We're working very hard to address the concerns around this rule, and we think that we're likely to be able to do so. I certainly hope that in the final rule that we come out with, we will be able to effectively address the concerns that people had, so that it won't be necessary to repeal the rule. That is my hope. We're certainly trying to do that.
And what is your time frame on that? Once you're confirmed.
I believe this is something we hope to get out hopefully later this year.
And you said you could do that without changing Section 716.
I believe that that's the case. We're hopeful that we'll be able to find ways to address the concerns.
Okay.
We understand the concerns, and are trying very hard to.
So do you share Chairman Bernanke's viewpoint?
I believe so. About the concerns that are there and the need to address them. I'm hopeful that we will be able to do so in the rule.
Okay, thank you. Since the start of the QE, the financial markets have responded to pronouncements by the Fed. Are you at all concerned that markets are too driven by speeches and official pronouncements from central banks around the world? And if the suggestion of tapering can contribute to volatility in asset prices, can we expect more volatility in the future?
Well, the Federal Reserve, and I think this is true of other central banks, we're trying as hard as we can to communicate clearly about monetary policy, both our goals and our intentions in terms of how we carry out programs. Now, this is challenging. We're in unprecedented circumstances. We're using policies that have never really been tried before, and multiple policies, and we're trying to explain to the public how we intend to conduct these policies. So it is a work in progress, and sometimes miscommunication is possible. But I think my own view would be we certainly want to diminish any unnecessary volatility. Sometimes there's volatility because we all learn news about the economy that changes our views about the course of the economy and the course of policy, and there it's natural to see a response. But to diminish unnecessary volatility, I think we have to redouble our efforts to communicate as clearly as we possibly can, and that'll be my emphasis.
Thank you, Mr. Chairman.
Senator Toomey.
Thank you, Mr. Chairman, and Dr. Yellen, thank you for being here, and thanks for our chat earlier this week. I appreciate that. I want to get back to where some of the issues Senator Corker was raising regarding monetary policy. But first, I just think it's important to stress, and I know you're very well aware of these, but the adverse consequences that we're already experiencing from directly as a result of the extraordinary monetary policy is really problematic, I think. We continue to have this artificially suppressed cost of funding these excessively large deficits that we run. It contributes to, I would argue, fiscal imbalances. We are punishing middle-class savers for years now. People who spent an entire working lifetime choosing to forego consumption because they decided they would save and they would have a little bit of income in their retirement. And now they have no income because they earn nothing on their savings, but they do watch as it gradually gets eroded, even by a low level of inflation, when they have no income from it. We have exacerbated the problems of underfunded pension plans, and we've got distortions in financial markets. So these are all the things that have been occurring, I would argue, and continue to occur. And yet what worries me perhaps even more is the point that Senator Corker was getting to, I think, which is what happens when this morphine drip starts to end. At some point, sometime, this is going to be, we're going to move away from this, I assume. I think everybody believes that. And the assumption seems to be that the markets will behave very benignly when that occurs. And yet we've seen I think some worrisome glimpses that maybe that's not a safe assumption. Back in June, the mere suggestion that some of the members of the Fed might be contemplating stepping back a little earlier, and 10-year Treasury backs up 100 basis points. Yesterday, the release of your testimony, and the equity markets rally. Doesn't this feel like there's something a little artificial here? And isn't it possible that while you have many tools available to begin and unwind, to retreat from this, that the markets may not respond very well, and that we could end up creating a real problem as we try to exit from this?
So, Senator, you made a number of different points, and I think the first point you mentioned is that low rates, in a way, give rise to fiscal irresponsibility, that it's takes the pressure off Congress. Yeah. You know, we've established low rates in order to get the economy moving, which is Congress's mandate to us. I think it's important for Congress to recognize that as the economy recovers and both short and long-term rates move up, a situation in which the government's funding costs remain as low as they are, if we're successful in achieving our goal of getting the economy back on track, this is a very temporary situation. And so I believe members of Congress should be looking out a few years to a time when rates are going to be higher. Low interest rates harm savers. It's absolutely true. And this is a burden on people who are trying to survive on the income from a CD. There's not much that they can get. But, you know, if you think about how can we get rates back up to normal, I guess I would argue that we can't have normal rates unless the economy is normal. At the moment, we have a lot of saving and not very much investment, and there are fundamental reasons here why rates are low. So I think pursuing a policy of low rates to get the economy moving will best enable us to normalize policy and to get rates back to normal levels over time. In terms of jumps in rates, we will, as the economy recovers, need to withdraw the monetary accommodation we've put in place. And we will make every effort to do so at a pace that's appropriate to continue the recovery and to maintain price stability and to communicate that plan to markets. But as we have seen, and as you indicated, it is possible for rates to jump. It was not just true now, but in previous tightening cycles, like the one we had from '94 and 1995, where long rates moved up over the span of 6 months over 100 basis points. We've tried to make sure the financial system is more resilient. In our stress tests, we have tested and continue to do so in this round to make sure that banks are appropriately managing interest rate risk. And that is a risk that, we will try to mitigate, but it is inherent in any tightening cycle.
Mr. Chairman, I know I'm running out of time. Just 2 quick points I'd like to make. One is I'd like to express my concern, which is the exact opposite of the concern that was raised by Senator Merkley, which is I think the danger of the implementation of the Volcker rule is actually could be too restrictive and increase the cost of especially corporate bond issuers. I think the decision by Congress to exempt U.S. Treasuries was an implicit acknowledgement that when you ban proprietary trading in those instruments, you make them less liquid and more expensive for issuers. I'm told that the next rule might very well also exempt other sovereign issuers, which is another implicit acknowledgement of this problem. This is a problem for corporate issuers in America, and I'm very concerned that we not unnecessarily raise their cost of borrowing. And the last point I would make is I'm deeply concerned about the consolidation that's happening in small banks, the lack of new small banks. As you know, we used to routinely launch sometimes hundreds of new community banks. I'm told by the FDIC there's not a single new community bank has been launched since 2010. The regulatory compliance for institutions that have no systemic risk to the economy is way overboard, and I hope you will make an effort to diminish that burden.
I promise to do so, Senator.
Right, thank you.
Senator Warren.
Thank you, Mr. Chairman. Thank you, Dr. Yellen. There's been a lot of talk today about the Fed's use of quantitative easing to try to help the economy get back on its feet. But the truth is, if the regulators had done their jobs and reined in the banks, we wouldn't need to be talking about quantitative easing because we could have avoided the 2008 crisis altogether. So I want to focus on the Fed's regulatory and supervisory responsibilities to keep the big banks in check. Now, I'm concerned that those responsibilities just aren't a top priority for the Board of Governors. Earlier this year, the Fed and the OCC reached a settlement with 13 mortgage servicers that had engaged in a long list of illegal foreclosure activities. And the settlement was for over $9 billion. It directly affected more than 4 million families. But the Fed's Board of Governors never voted on whether to accept the settlement. Instead, this decision was just left to the staff. Now, the Fed has smart, hardworking staff, but the Board of Governors would never delegate critical monetary policy to them. And yet, even now, after the biggest financial crisis in generations, the board seems all too willing to delegate critical regulatory and supervisory decisions. So I think we need to make reining in the banks a top priority for the board. So I know the board meets regularly to discuss monetary policy. Do you think the board should have regular meetings on supervisory and regulatory issues as well, making it clear that both of those are important to the Fed?
Well, Senator, I absolutely believe that our supervisory responsibilities are critical and they're just as important as monetary policy, and we need to take them just as seriously and devote just as much time and attention to them as we do to monetary policy. The board operates under a variety of restrictions. You may know about the government in the sunshine rule. And so when you suggest that the board meet to discuss regulatory matters, our ability to do so outside of open meetings is very limited. And so we tend to handle those by meeting individually with staff or meeting in small groups. We have a committee system where committees are put in charge of managing particular areas and making recommendations to the board. I remember in the 1990s that the board did regularly meet to discuss supervisory issues because there's confidential supervisory information, and it's easier for us to have a meeting, and I did consider those very valuable. And so I think that's a very worthwhile idea. I should just say, when there are delegations to staff and the Board of Governors doesn't vote, that doesn't mean that board members aren't consulted, and maybe those with expertise may have played a critical role and had very important input, even when there is no formal vote by the Board of Governors.
Fair enough, but I think it is an important signal here, and I'm glad to hear that you're thinking about this and thinking about the question of the appropriate delegation to staff and when it's appropriate to delegate to staff. Could I ask you just to say something briefly about that, about when it is appropriate to delegate to staff and when you have to retain for the board itself? Just very briefly, if you could, because I want to get on to one other question.
So I believe there are certain matters that under law the board must vote on, supervisory findings, mergers, and so forth, rule changes. Typically, we delegate enforcement matters to the staff in the area of supervision.
And I'm glad to hear, though, that you want to continue to think about that, particularly when we're talking about something this important.
Yes.
I want to ask you one other fundamental question here, and that is, do you think that the Fed's lack of attention to regulatory and supervisory responsibilities helped lead to the crash of 2008?
You know, I think in the aftermath of the crisis, we've gone back and tried to look carefully at what we should have done differently, and there have been important lessons learned. We have massively revamped our supervision, particularly of the largest institutions, which we now organize through a process called the LISC, where we're simultaneously reviewing all of the largest institutions simultaneously, and the Federal Reserve System works jointly on these reviews. We no longer delegate to individual reserve banks the supervision of, say, one or two of these large institutions. It's also become an interdisciplinary matter, and that economists and lawyers and others are involved in. So we've learned a lot there about supervision. I would say one of our top priorities now is ramping up our monitoring of the financial system as a whole to detect financial stability risks. I think that's something that we weren't doing in an adequate basis before the crisis, and so we missed some of the important linkages whereby problems in mortgages would rebound through the financial system.
Thank you very much. Thank you, Mr. Chairman. I just want to say, Dr. Yellen, when you're confirmed, and I very much hope you are confirmed, that I'm very glad to hear you will make it a top priority for the Federal Reserve to engage in the supervisory and regulatory responsibilities that help keep our financial system safe, and that cannot be something that is merely an afterthought, but has to be a primary effort on your part.
Thank you, Senator. I completely agree with that.
Good. Thank you.
Senator Reid.
Well, thank you very much, Mr. Chairman. And Governor, you demonstrated your wisdom early by going to Brown University in Providence, Rhode Island. And everything else after that is, I know, anticlimactic. But when you're confirmed as the chairman of the Federal Reserve, it'll be consistent with your record of wise selections and wise choices. Chairman Bernanke has indicated that many times our fiscal policy and our monetary policy have been working at cross purposes. The Federal Reserve has been quantitative easing. They've been trying to get an expansive policy in place, and we have been contracting, shutting the government down. We anticipate, I hope we can avoid this, but we're going to end unemployment, emergency unemployment insurance abruptly at December 31st. How would your job and obviously the size and scope of your portfolio and everything else, many of the questions have been asked today, be affected if our fiscal policy was complementary to your monetary policy?
Well, Senator, I agree that fiscal policy has been working at cross purposes to monetary policy. I certainly recognize the importance of the objective of putting the U.S. deficit and debt on a sustainable path. Congress has worried about that, and I think it's important to do so. But some of the near-term reductions in spending that we have seen have certainly detracted from the momentum of the economy and from demand, making it harder for the Fed to get the economy moving, making our task more difficult. And it certainly would be helpful going forward if it were possible for deficit reduction efforts to focus on achieving gains in the medium-term horizon and addressing those aspects of fiscal policy that give rise to concerns about debt sustainability over the medium term, while not subtracting from the impetus that we need to keep a fragile recovery moving forward.
And such a policy, a fiscal policy, would help you in terms of what we all anticipate is the point at which you have to begin your tapering, because basically this balance would allow you the more flexibility and more confidence that when you start to taper, it wouldn't lead to a reverse to a poor economy. Is that fair?
I think that's fair, Senator, because we are worried about a fragile recovery, and a more supportive fiscal policy, or one that at least had less drag, that did no harm, would make life easier.
Let me switch gears slightly, and that is that we were a few weeks ago discussing the possibility of default on our debt, and the markets were beginning to react. And given the central role that Treasury securities play, not just in funding the government, but also the tri-party repurchase markets, the collateral markets across the globe, were you beginning to see at the Fed sort of ominous signs of a potential catastrophic impact of the default?
Well, Senator, I do believe that a default on the U.S. debt would be catastrophic, and we did see some signs in the run-up to the debt ceiling that suggested that financial markets were taking notice, and that there were preemptive protective actions that market participants were beginning to do to protect themselves from what could have been catastrophic consequences. More generally, I think we did see an impact on consumer and business confidence that isn't helpful to general willingness to make investments in the economy. And
just a final point, we've been talking a lot about the size of your portfolio, but essentially, and I don't want to oversimplify it, the benchmarks that typically you're looking at is inflation and deflation and unemployment. And I think for a while, under Chairman Bernanke, there was a real fear, particularly in 2009 and 10, of deflation, which would have had adverse consequences. We've avoided that. We've avoided inflation pressures. And what we have not yet done is got the employment numbers at a suitable level. So I think the focus, the traditional and appropriate focus is on those measures rather than just the absolute size of your portfolio. Is that sensible?
I think that is sensible, Senator. We are very focused on achieving our dual mandate, which is we absolutely want to avoid deflation. We have a 2% price stability objective. We're trying to get the economy back to full employment. I do think we've made progress, but we're not there yet. On the other hand, as we recognized from the outset of the asset purchase program, there are costs and risks associated with a large balance sheet.
Thank you. Thank you, Chairman.
Senator Johanns.
Mr. Chairman, thank you, and it's good to see you again, and thanks so much for stopping by the office the other day. I felt like we had a good conversation, and I'd like to continue, if I could, with a few questions along the lines of what we talked about in my office. I found your testimony about asset bubbles to be interesting. Just before the chairman turned to me, I looked at where the Dow is at. It's about 15,850. An economy that, quite honestly, most everybody would recognize has too much unemployment, an economy where people continue to struggle, an economy where it's kind of hard to see where the growth is going to be. We're now starting to see real estate bidding wars, just like the old days. Now, that's confined to cities and certain areas of the country. We're now starting to see private equity firms, who I think are very good at looking where the economy is headed, and lo and behold, they're buying single-family houses. That was a shocker to me, having owned a few rentals in the past. I was kind of amazed that they would do that, but obviously they see something there. And so, Dr. Yellen, I kind of look at these factors, and I think I could go on and on with some other items, and I must admit, what am I missing here? I see asset bubbles. And I think if you were to announce today that over the next 24 months you're going to bring that balance sheet down from $4 trillion to 0 or $1 trillion, I think if you even said over the next 4 years we're going to bring it down from $4 trillion to 0, I think we would see how big those asset bubbles are. Wouldn't you agree with me on that?
So I think with respect to real estate, you mentioned real estate markets, and we certainly are seeing, as you mentioned, private investors come in to invest, and often all cash, in certain markets in the country. Is that an asset? Is that evidence of an asset bubble? So if you look at the markets where that's occurring, it's some of the hardest hit, the markets where prices went up the most, like Las Vegas or Phoenix, in my part of the country, that had the biggest crashes, where you have the largest number of foreclosures, with houses being put on the market and borrowers whose many of these housing markets where these investments are taking place are ones where you have a substantial fraction of underwater borrowers and individuals who have lost houses, whose credit is impaired, who are not in a position to be buying houses. And these investors are purchasing these houses often at very low prices for cash, and appear to be in the business of renting them out over a reasonably long period of time. I'd say, we have to watch this very carefully, but I don't see that as an asset bubble. I see that as a very logical response of the market to generate a recovery in very hard-hit areas.
Dr. Yellen, I don't want to be rude and interrupt you, but I'm also running out of time. And here's what I would offer. And I think you'd agree with me, although you probably won't want to agree with me in a public hearing setting. But I think if I were to say to you, why don't you announce today that you're going to draw this down over the next 24 months from $4 trillion to zero, I think you would see the impact of your policies on the value of real estate all across the United States, not just in the hardest hit areas. I think the real estate that I own and others own would go down in value. I also think that the stock market would have the same sort of reaction that it has had when Chairman Bernanke just suggested that there might be a phase down here. Here's what I'm saying, because now I am out of time. I think the economy has gotten used to the sugar you've put out there, and I just worry that we're on a sugar high. And that is a very dangerous thing for the little person out there who is just trying to pay the bills and maybe put $1 away for retirement. Last thing I'll say, the flip side of your policies that you're advocating for are very, very hard on certain segments of our society. You know, explain to the senior citizen who is just hoping that CD will earn some money so they don't have to dig into the principal what impact you're having on a policy that says we're going to, for as far as the eye can see or foreseeable future, keep interest rates low. They are hurt by that policy.
Senator, I agree, and I understand that savers are hurt by this policy, but you know, if we want to get back to business as usual and a normal monetary policy and normal interest rates, I would say we need to do that by getting the economy back to normal, and that's what this policy, I hope, will succeed in doing. The other thing I think it's important is to recognize that savers wear a lot of different hats. They play many different roles in the economy. They may be retirees who are hoping to get part-time work in order to supplement their income. They may be people who have children who are out of work and who are suffering because of that, or grandchildren who are going to college and coming out of college and hope to be able to put their skills to work, finding good jobs and entering the job market when it's strong. And I think when those people who worry about our policy, thinking about themselves as savers, take into account the broader array of interests they have in a strong economy, they would see that these policies, even though they may harm them in one respect, are broadly beneficial to them, as I believe they are to all Americans.
My time has expired. Thank you, Mr. Chairman.
Thank you. Senator Heitkamp.
Thank you, Mr. Chairman, and thank you, Dr. Yellen, for hanging in there with us. Those of us at the end of the desk love an opportunity to ask you some questions as well. I want to get back to the Fed goal of full unemployment, and I want to ask just some quick questions. Give me a number on what you consider full unemployment or employment.
So don't have a precise estimate, but every 3 months, all of the participants in the FOMC fill out a survey and indicate what they think the normal, longer-run level of unemployment is. And in our most recent survey in September, the range of opinion was 5 to 6%.
Okay. And tell me, what do you believe the real unemployment rate is today?
Well, the measured unemployment rate is 7.3%.
I know the measured unemployment rate.
But as
that wasn't the
we've
question.
Discussed previously, we have very high incidence of involuntary part-time employment. We have all too many people who appear to have dropped out of the labor force because they're discouraged.
I don't want to belabor this committee hearing any longer than what I have to, but would you agree that it is at least close to or probably over 10%?
Well, certainly by broader measures, it is that high.
Okay, and would you also agree that right now in America, we have the greatest income disparity that we have had since the Great Depression, right before the Great Depression?
We've had widening wage inequality and income inequality in this country going back to the mid to late 80s, and that continues.
Yeah. So I just want to take a moment to speak for maybe those folks who are on the lower end who look at the Fed policy and look at the stock market, don't have a stake as they see it, as you just explained to Senator Johans. We all have a stake in this economy, but their day-to-day, they don't see a stake. They don't see their economic condition getting any better. And certainly, they don't see their employment opportunities getting any better, especially for those with low job skills. I won't say low education, but low job skills. So what can you do, or what have you done to address income disparity, unemployment disparity in this country, and what would you suggest that the Fed pursue to avoid the consequences long-term of that income disparity?
Sir, I think you're asking about something that is a very deep problem that's afflicted the U.S. economy and other advanced economies. Economists who spend a lot of time trying to understand what's responsible for widening inequality, and many of the underlying factors are things that are outside of the Federal Reserve's ability to address.
Do you believe your policies have added to the problem?
I believe that the policies we've undertaken have been meant to generate a robust recovery. I would like to see the U.S. economy and the job market recovering more rapidly than they are, but I believe our policies have helped. And I think, as we saw during the 1990s, when we still had trends toward widening inequality, we did have real wage gains, and we did have a reduction in inequality when we had an exceptionally strong and getting ever stronger job market. So faster growth in the United States is going to help a stronger job market. And, you know, when the economy recovers, we're going to see firms be more willing to undertake training. When they can't find workers, they're going to be willing more to invest in people, to hire, to make capital investments that will make workers more productive when they're on the job, and we'll see greater wage gains.
Just a final comment. I would suggest that those at the bottom aren't feeling the effects of these policies. The trickle-down hasn't happened for them, and so they struggle every day, and they may not see their wealth grow because they don't hold a lot of assets. And so anything that you can do, taking a look at this broader issue, because this is an issue that will affect the American economy for years to come and affect our competitiveness in years to come. They're the consuming class. When you look at why consumers aren't consuming, because we aren't getting resources to those who do consume. And so I thank you for your willingness to serve and look forward to a long relationship with you.
Thank you, Senator.
Senator Manchin.
Thank you, Mr. Chairman, and thank you, Ms. Yellen. And I enjoyed our visit, and you've done a great job today. Let me just say this, that I look at you and think that there's a person who was involved the last time we had a balanced budget, the last time that we would have been on track to be debt-free. If you go back to those days, I'm sure there was naysayers then said we couldn't do it. It'll never happen, but you all did it. And then we went off the tracks. What I'm asking is how we get back on the tracks. I know quantitative easing, you and I have a little difference of opinion on this, or concern. I have a concern, but you have a concern. You have a little, I think, broader view of what has worked or not worked around the world. I think we spoke about Japan and why you believe that what we're doing needs to be done. I would only say this: if $85 billion a month in quantitative easing has not really given us the results that we desired, why wouldn't you recommend doing $200 billion a month? You know, why just 85? We know that hasn't worked. And of course, I have concerns with doing it, continuing it, because I don't think, as I think that Senator Johans had said, we're on a sugar high. The bottom line is you all have done your job. You've done everything possible to prop up this economy. We have failed miserably as Congress to do our job. And to me, to get even a budget, we don't even have a budget. And then to say that we could have a balanced budget, people think we're crazy. It can't happen. It'll be too harmful, a balanced budget. Those of us who were governors and come from the executive branch, that's all we understand. We had to by law. And then to even think that we could be debt-free in the next generation or beyond. Do you think those are impossible or unreachable goals?
Well, Senator, I feel achieving debt sustainability over the medium term for this country is an exceptionally important goal.
Could we balance the budget again?
It requires very tough decisions, as you know.
Well, you made decisions back in the 90s. They said, I remember the dialogue then couldn't be done.
Well, we did make tough decisions. Congress and the administration made very tough decisions in the 90s. They did it in a way that I would think would set a model in a sense for this Congress. When President Clinton was elected, the economy had high unemployment. It was just beginning to recover. The administration and Congress wanted to achieve deficit reduction, but to do so in a way that wouldn't harm the economic recovery. And so they agreed on a set of tax increases and spending cuts, not all of which came into effect immediately, but were phased in over time. There had been at that time a lot of uncertainty among businesses and in the markets, among households, about whether or not the government would ever balance its budget. And the response was very positive. Long-term interest rates came down. Now the Fed had scope to use monetary policy to offset anything, adverse impact on the economy, but we really didn't see a lot of adverse impact because the fiscal tightness was phased in over a period of years, and the economy enjoyed a long and robust boom.
Let me just say this, that you having that experience and lived through it, worked through it, and was successful with it, and we have the utmost respect for the Reserve, yourself, and I'm sure that you see the committee has the utmost respect for you. We just need you to speak out and help us a little bit more and challenge us to do our job. If people like yourself who are in the know are unwilling to challenge us, I'll guarantee you we don't have the political will, it seems like, to do what needs to be done. We have got to get our financial house in order. Every citizen in America has to face a budget. Every one of them has to live within that budget. And we're unwilling to make that difficult decision. We're not on a sugar high. We're going to go into sugar shock pretty soon. And that's what I've been talking. But unless we hear the unbridled truth from people in the know, people who have been there, they said you couldn't do it and you did it. So it's not like it's the impossible dream. We've had budgets, haven't had one for 6 years. We've balanced budgets and we've had surpluses. I like to get back to that again, and I think people like yourself can help us be steered in that direction. So be bold.
Thank you.
Be bold.
Thanks, I appreciate that.
Senator Schumer.
Hi, thank you, Madam Chair, and thank everybody. I just want to follow up first on a question that Heidi Heitkamp talked about, and I agree with Senator Manchin that the deficit is a serious problem. It's less of a problem than it was a year or two ago, and I know you acknowledge that, but it's not our greatest problem. Our greatest problem is that middle-class incomes are declining in America for the first time in American history, in my judgment, in terms of our political economy. And the amazing thing is they declined not just because of the recession, but they actually declined between 2001 and 2007. And serendipitously, if that's a word, the person who alerted me to this attention was a professor at Harvard Law School named Elizabeth Warren, who wrote articles about this long before being a senator was a gleam in her eye. But it's our most serious problem. And if middle-class incomes continue to decline, they decline close to 10% between 2001 and today, this is going to be a different America. I tell this particularly to business executives I meet. I get in New York, what's all this populism about? Well, I say, you know, the American people are a generous people, and they don't mind if the people at the top income goes up 20%, if theirs goes up 3 or 4. Well, when theirs starts going down, it's a different story. And we've never had that in America. So my question to you is, how concerned are you about this? What impact will it have on growth and our economic potential? And does the Fed have tools to do this? And I understand this relates to some of my Republican colleagues' skittishness about continuing some policies that maintain growth. But I do think, given the seriousness, at least which I regard this problem, that the Fed has really a dual mandate, which I know you observe, which is not simply keeping inflation down and not simply monitoring the budget deficit and its effects on our economy, but in trying to get jobs and middle-class incomes back up again. It's so serious, and frankly, no one gives it the attention that it needs. So it's your...
Well, Senator, I want to echo my agreement with you that this is a very serious problem. It's not a new problem. It's a problem that really goes back to the 1980s, in which we have seen a huge rise in income inequality with, as you said, for many, many years, the middle and those below the middle actually losing absolutely, and frankly, a disproportionate share of the gains. It's not that we haven't had pretty strong productivity growth for much of this time in the country, but a disproportionate share of those gains have gone to the top 10% and even to the top 1%. So this is an extremely difficult and, to my mind, very worrisome problem. There is a lot of research, a lot of debate about exactly what the causes of this problem are, perhaps having to do in part with the nature of technological change, with globalization, with institutional changes in the United States, including the decline of unions. But there are many things that are involved in this problem. What can the Fed do? We can't change all of those trends. The solutions involve a multitude of things, including education, maybe early childhood education, job training, other things. But what we can do is try to achieve, as we are, a robust recovery so that we create jobs, we have a stronger job market, and in a stronger job market, people who are having a lot of trouble getting jobs will be drawn into jobs. They'll get better jobs. There'll be more training. People will move up job ladders, and opportunities will increase. It's not going to put an end to the problems, these long-term structural problems that are driving this, but it will be helpful, and I think it's the contribution the Federal Reserve can try to make.
Right. Just related to that, but in a specific, some of my colleagues have criticized you for keeping rates, quote, artificially low. But isn't the zero lower bound on the short-term interest rates in some way also artificial? So let's say rates were 5% today, but we had high unemployment, very low inflation. Wouldn't you lower rates? And isn't QE2 just another way to influence interest rates when you get close to the zero mark? So if you didn't do QE, wouldn't real interest rates be artificially high, so to speak?
I think that's fair if you judge what's artificial, what's high or low by the needs of the economy. People sometimes talk about a concept called the equilibrium real rate. It's what's natural given the levels of saving and investment in the economy. When there's a lot of saving and not very much investment, which is where we are now in a weak economy, the natural forces of the economy are pushing interest rates down. And it is these forces that we're trying to go with if we were to try to push rates up when the economy has that much saving and such weak investment, we would truly harm the recovery. And of course, having pushed rates to zero According to many estimates, we would ideally have negative short-term interest rates. Of course, we can't achieve that, and as you indicate, that's why we're trying to push down longer-term interest rates.
I think you'll make a great chair, and your Brooklyn wisdom shines through.
Thank you very much. I never forget my roots and appreciate that.
Thank you, Dr. Yellen, for your excellent testimony. I ask the members of this committee submit any written questions for the record for Dr. Yellen by close of business tomorrow. Dr. Yellen, please respond promptly so that the committee may proceed to a markup as soon as possible. This hearing is adjourned.